We'll start with the webinar. Thanks for attending. So today we have a company initiation, City Developments. It's a large cap property developer. And we also have several results update. First we have SGX, we have Keppel DC, and followed by Cash Logistics. Now, for City Developments, it's a household name along with Capital Land. So Capital Lands and City Developments are the large cap property developers. So what we have done is we initiated coverage. We initiated coverage with accumulate rating. Target price is $9.98. Last close was $8.77. So between the 52-week range of $6.55 to $9.24, hit a low of $6.55 during the Brexit period, but it recovered very quickly after that. Market cap is $8 billion. And just a little bit about the gross asset value of city developments by the segment. Singapore residential properties is still the largest segment of its assets, followed by the. Sorry about it. Just give me a second. Sorry for the interruption. Right. Okay, I'll just do it again. Singapore residential properties, it's the largest segment, 37%, followed by Singapore offices. And what's actually interesting to note here is that the Millennium and Copthorne is actually a lease co by itself in the London Stock Exchange. So for people who are following the City Developments Hospitality Trust, Millennium and Copthorne is the sponsor of CDLH Trust, and CDL owns 65% of these of MNC or Millennium and Copthorne. So now in Singapore property development segment, again 2 weeks ago we actually talked about the short supply of new CCR properties or the core central region properties. And just a reminder, for the benefit of those who did not attend the presentation, there was a 3-year time gap with no land sales in the CCR segment. The previous land sale was in July 2016, won by Guoco Land. It will add another 500 units or so. But in order to get planning approval and things like that, so before sales can actually begin, you need a planning approval. And before planning approval can be obtained, it probably takes like maybe a year or so. So, and followed by these land sales in July 2016. The last one was in November 2013. So there was a 3-year time gap when there was no land sales at all in the CCR segment. So going forward, there will be a time when there will be no launches. And just to bring everyone's attention to the chart over here, this is the ratio of CCR to the rest of the market segment. CCR to RCR. RCR is rest of central core region or rest of central region, and OCR is outside central core region. So the line over here suggests that right now is that the proportion of CCR properties to the rest of the market segments is at the historical low, at least at a 10-year low. And then again, on the chart on the right, CDR's portfolio of unsold units as at second quarter of 2016, 40.7% of its portfolio is exposed to the CCR segment. So with a tight supply, it's just a matter of time before price starts to turn upwards. And CDR is well positioned to actually capitalize on it. Now, yes, correct. We do that. There will be some near-term price pressure in the CCR market segment, especially with D9 and D10. So District 9, District 10. District 9 is in the Orchard segment, and District 10 is in the Bukit Timah segment. So average selling prices of these new developments within D9, D10, D11, it fell 20% or so in the last 5 years. And just 2 weeks ago, there was a transaction by Heaton Group where they sold off these iLeaf at Grange. It's a 30-unit luxury development on Grange Road, or the D10 segment. It was sold at it was transacted at a price of $1,623, and based on our estimates, they are most likely to recognize a loss of $307 PSF or so. Now, jumping back to city developments, at this point of time, in the D10 segment, they have Gramercy Park, which 22% sold. It was launched in May 2016. They also have Clifton at Grange, which is a slightly more dated property. It was launched, or it was TOP in 2011. They still have around 37%. They only managed to sell 37% or so during this period of time, and this also includes those that were being leased out. And finally, there is one new development. It's close to its TOP, but it has yet to be launched. That is New Futuria. Now, what is interesting about these three properties is that these are all freehold properties. And coming to that, so just one chart before that, whatever they have right now in the CCR segment, those that are more than 10%, they have at least 10% that is remaining, that is unsold. Most of these are all freehold properties, minus a way up at Robertson Quay. And last Friday, there was a rather timely news. So CDL managed to launch its third profit participation security, or PPS in short. And this transaction actually injected Novo 18. And for some of you who are following the property market, you probably will know about Novo 18 being the limelight. So why is it so? Is because of the impending QC, which CDL was supposed to pay for this development project. And this is a 154 unit luxury development. Is in the Upmore Park, one of the most prestigious districts in our in Singapore. So last Friday was launched, and it was injected into the third PPS for $977.6 million. And in return for that, investors get a 5% yield per annum. So what does this mean for CDL? Essentially, you can think of it as a one stone kill three birds kind of scenario. Because by selling at $977.6 million, it has unlocked shareholders' value. And if you work this out, it's $2,750 per square feet. So it will be able to recognize for them a 22% profit before tax margin. And again, this is based on our own estimates. Second thing is, of course, it avoids the impending QC extension charge, $37.2 million, or essentially around $200 per square feet. First year is $200. So just a bit of recap. How QC works is that a developer is supposed to develop and sell a property within 7 years. This property was due for QC in November 2016. For the first year of extension is 8%, or works out to be 37.2 million. Next year is 16%, and essentially you can double this amount. That's around 75 million or so. And third year onwards is capped at 24%. That is like more than $100 million already. So being able to inject this into PPS 3 will mean that they will no longer have they are no longer liable for this QC extension charge. And finally, they are able to expand their fund management platform. So in 2014, the new CEO, Grant Kelly, he actually came in to give a target, which is to expand their fund management business to $5 billion by 2018. So at this point of time, including the third tranche of PPS, it's already at $3.5 billion, or 70%. It's already reached 70% of its target. Well on track to meet the $5 billion target. So one of the most, I guess, one of the burning questions would be, is there a need for CDL to do a fire sale? I think our answer for now is that there's absolutely no need for them to do so after they have pumped Novo 18 into the third PPS. So let's jump directly into the two tables below here. You look at QC, the next QC deadline to meet is May 2018. That's like more than 1.5 years away, and it doesn't. It means that they have no QC to be payable within this period of time. So it's long enough, or at least there's still some time for them to sell these units, and there's no hurry for them to actually cut prices for these developments. But on the ABSD portion, for venue residences and Commonwealth Towers, there is a slightly closer deadline, which is next year, 2017, and December 2017. But then again, for these two developments, they are unique in a way. We'll dive into more details later. So minus away venue residences and Commonwealth Towers, the next set of ABSD deadline is from the Criteria and the Brownstone. These are EC developments. And finally, for the last one, which is Forest Woods, it was just launched, and within the first weekend of launch, it's really 66% sold. So the remaining 34%, they have like more than 3 years to sell these units, which is most likely not a problem at all. So in summary, there are 7 development projects that have more than 10% unsold units. And again, no QC ABSD due for the rest of 2016. Next is September 2017. And what is good to note is the strong balance sheet which CDL has. It's 20% net gearing, which includes the fair value gains on investment properties. So a strong balance sheet means that, what it means is that it's not pressed for time to clear these units because they can actually hold it. And this is unlike the case of Heaton. I mean, just to go back a few slides. Just now we talked about iLeaf at Grange. It was sold as $1,623. We all know that it's worth more than that. But the fact that they have to sell at such fire prices is because the balance sheet does not have strength to hold the development. And this is very unlike the case for CDL. At 20% net gearing, they just have a lot more firepower or holding power to hold on to these developments, and finally wait for the market to turn around and sell for better prices. So, and still on the balance sheet, so the strength on its balance sheet. Balance sheet has $3.3 billion in cash and net gearing of 26%. So it's different from 20%, yes, correct, but this 26% is based on assets being held at cost. So even at 26%, it's much lower than historical average of 40%. Again, just look at the chart here. The red line is the historical average. So just focus on this area here. It has, for the past few years, it has always been around 20% territory or so. And they just have a lot more firepower, a lot more ammunition left in this arsenal. And having a large cash pile, low gearing means that they can pick up value accretive investments when these opportunities surface. Now, moving away from the CCR segment, we go into slightly further, the RCR segment. So 2 weekends ago, CDL launched Forest Woods. It's a 519-unit development in Serangoon. On the first weekend of launch, they sold 66%. And why is that? This buoyancy in sales is mainly because of the smaller size units in this development. And why are they able to sell more? Like I said, that is that the size is much smaller. So average size of units in this development is around 754 square feet or so, as compared to this other development which it has is the venue residences. So the venue residences is 44%. No, sorry, it's around 50% or so. 50% or so that is left unsold. And this is mainly because of the larger size that it has compared to Forest Woods. So venue residences size of it, average size is 963 square feet, and Forest Woods is 754 square feet. Essentially, you're looking at around 20% bigger size units. So why bigger size units are harder to move is because of the higher quantum or higher purchase price involved to buy the development. So just to remind everyone again, there's also this 60% total debt servicing ratio cooling measure in place. So meaning to say that a home buyer monthly installment, or the monthly installment involved for mortgage cannot exceed 60% of their monthly gross income. Oops, sorry. So having smaller units will just means that it will be easier for developer to move. Now, just now we are talking about Commonwealth Towers and venue residences. So these developments in the near term, or at least in the near term, there will be some pressure on the average selling prices. So let's start with Commonwealth Towers first. Commonwealth Towers is an 845 unit mass market development in the Queenstown area. So till today, there's still left more than 50% or so that is unsold. And moving forward, we expect some price cuts to it because of the numerous competition that is in this area. And if people are following the property market, just yesterday or 2 days ago, Queen's Peak is a new project by MCC Land. It was launched on 2 days ago on Saturday. It will add another 736 units to the area. So there's still plenty of competition going on. But what is also encouraging to note is that year-to-date average prices, transacted prices for Commonwealth Towers is 1,750, and compared to the break-even cost of $1,400, there is still a lot of room for them to do price adjustments. And the first mover advantage that CDL has, they really locked in 50% or so that they've already sold 50% or so during the initial phases. So going forward, even if prices were to, I can't say that the rest of the 50% unsold. I can't say that if wrong. What I'm trying to say is that even if some of the proportion of units, unsold units, even if they are priced below break-even cost on an average basis, based on the average selling prices, they will still be able to make money from it, and that's really an important consideration. Now, again, we believe that there'll be further price cuts simply because year-to-date sales volume for Commonwealth Towers has been 36 units. So for the past 10 months, they only managed to sell 36 units. And moving forward, in order to avoid the ABSD remission clawback, which will happen in December 2017, they have to sell 32 units per month. So it's still a far-fetched. They will still take quite a bit of time to either take more time to sell, or they have to cut prices in order to make it competitive. And we think that most likely they will cut prices in order to move these units. Next, for the venue residences, it's pretty much the same situation here. And there is a nearby development called Poyers Residences, and it's 166 units unsold. So competing with venue residences, which have another 115 units that are left unsold, where 110 units haven't been launched yet. So this doesn't include a recent en bloc transaction by UOL Group. So they've actually en bloc a nearby development called Raintree Residences. All in all, it will add another 900 units or so. So 166 units from Poyers Residences unsold, plus 750 units from Raintree Residences that will potentially be added into the market when planning approval is obtained, of course. So next is that the purchase price of units in venue residences is much higher than Poyers Residences because of the larger size units. So venue residences have much bigger sizes. Units are definitely much bigger than Poyers Residences. So again, like I said just now, bigger size means higher quantum. Higher quantum means that with the binding constraint from the 60% total debt servicing ratio, it's going to drive some home buyers out of the market. So so sales volume or sales momentum in venue residences is expected to be slow. But again, what's also encouraging to note about the venue residences is that land price is secured at the lowest as compared between all these three projects. So for venue residences, the land cost per square feet price was $710 Police Residences $775, and Raintree Residences is the highest at $797. So if you compare between Raintree Residences and Venue Residences, you're looking at something like 15% difference in land cost. And having a lower land cost will give more ammunition when it comes to cutting prices. And I think that this will bode well for CDL. Okay, this is just a reiteration of what we had said 2 weeks ago. So in summary, we think that it's still premature for the Singapore government to unwind existing cooling measures because a bit of background information is that in 2013, property prices actually came to a peak in 2013. So up to today, prices only came down by 10% or so. And when you match this with price gains on private properties, private property prices have grown more than close to around 70% in the past 10 years, while median wage was only up 60%. There is a mismatch towards the growth in prices of private properties as compared to median wage growth. So in other words, it's still premature for the Singapore government to unwind the existing property cooling measures. Nonetheless, they also kept reiterating that they are committed to seek moderate growth and, more importantly, not create a hard landing in the real estate market. Now, next, having said all this, we think that demand, or wherever that we're seeing absorption of these unsold units, or demand for property will continue to be slow. And what we like developers with strong balance sheet, like in the case of CDL, and they are in good stead to weather this period of slowness. And quickly we'll jump into the Singapore investment property segment for CDL. Rental properties contributed 21.3% of total profit before taxes, and is the second largest contributor of profits. So, and within is investment properties. Office properties form bulk of the portfolio's value. 72.6% of investment properties are formed from office properties. So now, there is softness in demand for an office space, but what we really like about CDL is that it continues to enjoy healthy occupancy rates, and the portfolio's occupancy rate is 97.4% and is much higher than the national average of 90.9%. Now, they recently had a mixed development, South Beach, which consists of a hotel, office, retail space, and 190 residential unit. And as at the second quarter of 2016, office properties or its office units have already been 99% leased, or as good as all leased already, and retail space is greater than 76% leased. So even in a soft market environment, they were able to lease out its office space, and I think that is very good execution on their part. And jumping into the retail space, and around more than 50% of this retail space is really open to the public, is really functional. But what is remaining is the hotel segment and the residential units, which we'll be providing updates and we'll be monitoring closely. I'll pass the time to De Hong, who will be talking about the hospitality segment and the international property development segment for CDL.
Hi, good morning, guys. I'll next go on to touch on the hospitality segment for CDL. CDL and Kwek Ling Beng, they are both pretty big in the hospitality sector. Apart from the hotels CDL own in Singapore, such as your St. Regis, your W Hotel in Sentosa, one big one big component of CDL's hospitality business is the 65% stake that they have in Millennium and Copthorne, and that entity is listed in London. So before I go on to talk about MNC, maybe I talk a bit about the industry as a whole for the hoteling industry, how they operate, and what kind of business models that they do have. So if you look around the world, a lot of these major hotel operators, they operate via mainly two main business models. The first one is the capital intensive, where they own most of the hotels and then they operate the hotels as well. So they are owners and operators. Another business model is where they do not own the hotels, but then they will manage the hotel and operate the hotel, and then they will collect management fees from operating the hotel. So management fees in that second model, you'll be more stable, and it's an asset-like strategy where it is more conducive for expansion as well, because you don't have to incur heavy capital expenditure on buying hotels, buying new sites. You can just do management contracts for hotel owners who do not know or who do not have the expertise of running hotels. So differences in the pros and cons. For the first one, if you own the hotels, then the upside is that you actually get to participate in the capital appreciation for the hotels. So over the years, we have seen that the old model is that hotels, they used to own, these operators, they used to own most of the hotels. Like, for instance, let me quote you the example of Hyatt. They used to have a bigger ownership of their own hotels in the portfolio. Right now, you're looking at 6%, right? So of all the Hyatt hotels in the world, they only own 6% of all these hotels. The rest of the hotels are all owned by third parties, and Hyatt is just going in there to operate it. So they used to own most of the hotels, and then in recent years they began to divest the hotels and began implementing an asset-like strategy. So you see that for MNC, they're actually one of the heaviest capital intensive business model amongst the rest of the international hotel operators. They actually own 67% of their hotels. So what we see since the post-GFC is that since 2010, I think it's not surprising, it is not coincidental that if you look at the recovery of all these hotel chains post-GFC, the ones which are more capital intensive and more asset heavy, they are actually recovering the slowest. You look at the three bottom lines at the lower tier, you have Millennium and Copthorne, that is the worst performing. They have only recovered 39% since 2010. And then joining MNC is Accor and Hyatt. So you see MNC, Accor, and Hyatt, this happen to be the highest three hotels which own the biggest proportion of the hotels in the portfolio. The other end of the spectrum, you look at Intercontinental. Intercontinental actually recovered the most, and they own the list of the hotels in their portfolio. So it seems like investors actually prefer this kind of asset-light strategy where you can expand faster, and then have a more stable income as compared to owning the hotel and being subject to the ups and downs of the tourism sector. Because if you're just a manager of the hotel, you probably collect a management fee which is fixed, and you will have another component which is maybe a certain proportion of the gross revenue or the rental income of the hotel, but you will still have the management fees, the stable management fees to fall back upon. Unlike if you're MNC, you're owning the whole hotel, so your entire P&L will be based on the ups and downs of how well the hotel does. So okay, back to this point. So it looks as though like asset heavier hotel operators are performing not as well as the asset light operators. But having said that, we know that the hoteling industry is a very difficult business to be in. So there was an interview a few years ago there was this TV presenter. He was interviewing Kwek Ling Beng, and then he was asking him, if given a choice to choose again, would you still go into the hoteling industry? Because we all know that it's a tough business. It's a very capital intensive, low returns, and then you make returns on your business, but the cash flow that comes in, you have to reinvest them to refurbish your rooms, improve your facade, and keep your hotel up to date with the rest of the hotels. Otherwise, you'll lose out, right? So you got to keep reinvesting your proceeds, and then it's such a capital intensive business, right? So he was saying that if given a choice, he would not be in this business. But the other thing to note is that for MNC, they carry their hotels at book, at cost, minus accumulated depreciation and any impact charges. So we know that this is a tough industry to be in, but then valuation wise, we think that for MNC, the current price to book value is 0.56. You are holding your hotels at cost, and you are trading at 0.56 times of this cost. So you're ignoring any kind of capital appreciation from the hotels from the time that you have bought. And if you look at in recent years, with all this loose money going around, cap rates for hotels have been falling. Falling cap rates would mean that the capital values of hotels is increasing. And then if you can just pull out any of the REITs, hospitality REITs. Okay, if you look at those with properties in UK, for example, because all these REITs, they revalue their properties every year. So you look at the valuations of all these properties, most of the time in these past few years, they've been trending up. So of course it's location dependent as well, but most of the time these few years, with all this loose money, cap rates have generally been falling. So MNC is currently trading at below the 10-year average mean price to NAV valuation of 0.7. And we know that because MNC own most of the 67% of the hotels, so their business is not unlike those that the S-REITs in the Singapore hospitality sector are doing, because the hospitality S-REITs they also own the hotels as well. And then some of them do have master leases, which are more secure, more stable earnings. But across the board, you look at all these hospitality REITs, the proportion of master leases that contributes to the entire income can go as low as 17%, 17. For instance, like for Ascendas Hospitality, master leases is only 17%. So the rest of the income, you're actually very subject to the ups and downs of the tourism industry. So with a similar business, you see that the hospitality S-REITs are actually trading at 0.66 to 0.92 times the book value. So from this, you can also see that MNC's valuation right now is on the low side. So any reversion to mean in the trading valuations for MNC or any monetization strategies could actually be positive for CDL. And we know that in the past, there have been track records of monetization strategies by CDL. For instance, the restructuring of the Singapore assets under MNC, they actually put it under CDLHT and then IPO'd it. And then for first sponsor as well, that one was CDL had a 45% stake before the listing of first sponsor, and then post-listing, post-monetization, they managed to cut down their stake to 35%. So since we're at this topic, we're talking about hotels, maybe we should talk a little bit about the tourism outlook as well. And for CDL and MNC, London and Singapore are actually the two biggest markets for the company. These two countries actually make up about 70% of the operating income for MNC in 2015. So you see a breakdown of MNC's 126 hotels. Most of them are in Asia, Singapore, and then in Europe as well. So for these two countries, the outlook for the tourism sector in this year, judging from the data that has been coming out for the first 7 months of this year, is actually improving. How so? We look at London first. For 2015, London actually welcomed a record number of international tourism visitors, and this 18.5 million is actually a 6.8% growth year on year over 2014. So 2016 has been a slower year, but then in June we saw another event which could potentially be a game changer for the tourism sector in that city. That is the Brexit and the subsequent decline in the pound after Brexit. So we saw that after June, right, the GBP actually dropped close to 14% since June against the USD. So it's currently doing about 1.27, and with this weakening of the GBP, that actually puts more spending power into the hands of travelers into the city, and already we are seeing signs of the catalyst from this increased spending power. So in July, there was a statistic that came out that said that the sales of jewelry and watches from international travelers is up 16% year on year in July. And then you see that the international tourist total receipts in July, they actually broke a 4-month downtrend as well to grow 2.3%. So like I mentioned just now, GBP has actually depreciated about 14% against the USD since the Brexit in June. And the composite forecast, according to Bloomberg, that means it's a pooled consensus for the economies that were polled by Bloomberg. Their forecast for the rate, the GBP USD rate, is 1.32 going forward to 2017 and 18. So that means to say there's a likelihood of continued depression and weakness in the GBP according to this composite forecast. And this continued weakness in the GBP could actually help tourism. We have a case in point. We have an example previously from Japan, right after 2012 when the Prime Minister Abe took office and implemented his 3-arrow strategy. The yen actually started weakening. Right, if you can tell from the chart on the left, it fell from 1 USD is to 80 Jap yen to as high as 1 is to 120. That's a 50% decline in 3 years. And in that few years after 2012, since the yen started to weaken tremendously, you see that the international arrivals and receipts actually grew by a tremendous amount as well. And it went as high as a 47% year-on-year growth in 2015, buoyed by the weak yen and the increased spending power for tourists. So we could see a similar case for London going forward as well. For Singapore, 2016 data for the first 7 months has showed a bit of improvement as well. We had our tourist arrivals growing 11.8% for the first 7 months, and this is actually an improvement from the last 2 years. 2015 we had a 0.9% increase, 2014 we had a slowdown of 3%. So this year, January to July, grow 11.8%. That's actually a very big improvement from the last 2 years. And then total room revenue as well. Average growth for the first 7 months this year is about 3.8%. And 2015 we only saw a 0.9% increase. So what's next for tourism industry? With oil prices expected to remain low, they can be a booster for tourism industry in the form of cheaper travel tickets. And as for the impact of new sharing economy businesses such as Airbnb on the hoteling industry, we think that the CDL's portfolio, if you look at what they have in Singapore, is Sandwiches, they have W Hotel. If you look at the Millennium portfolio, most of the time they're catering to corporate travelers as well as high-end travelers. So while Airbnb will cater more to the budget-conscious travelers. So we think that this impact from Airbnb is likely to be minimum on CDL and MNC. So I'll move on to another segment of CDL. This is the overseas residential projects. As Peter earlier mentioned about the diversification of CDL overseas, right, to counter the slowing property market in Singapore. This strategy is gonna start reaping rewards for the company from 2016 to 2018. The reason for this is that for residential projects overseas, the method whereby the company recognizes revenue is such that, unlike in Singapore, where in Singapore you can recognize revenue as you build the project progressively. If you're 35% through the construction, you can actually start to recognize 35% of what you have sold, and so on and so forth. But then, let's say for an overseas project, if you're 90% constructed, but you're fully sold out, you still will not be able to recognize a single cent from that project, because the rules are such that you will have to finish building the entire project before you can recognize any form of revenue from the project. So for CDL, in the next few years, you will see quite a few completions going forward. If you look at the table below, these are the launched overseas projects under CDL. Let's look at Australia. 90% sold. It's going to complete in 2018, and then there's the UK one as well. The Hanover house is already fully sold, and most of the sales will complete by the second half of this year. And one of the major projects for CDL in China is that they have this Suzhou Industrial Park project, which is a mixed development. There are residential units there are hotels, offices there as well. That project is actually is already profitable because they bought the land for a cost of 880 million renminbi, and the project has two phases, phase 1 and phase 2. Phase 1 is already launched, 70% sold. Phase 2 is about to be launched, but the revenue from whatever they have sold in phase 1 is already up to a sales value of renminbi 2 billion versus a cost of 880 million in the land purchase. So just from the phase 1 sales alone, they have already achieved above the break-even point for that project. So that is for the Suzhou part. And then Shanghai, they have this Hongqiao Royal Lake as well. That one is only 21% sold. It's already completed, but those are refurbished villas in Shanghai, which the company is not in a rush to sell, because there have been regulations in China which restrict the upcoming land sales for projects which are deemed to be low density. And this would mean that projects such as, if you are a developer, you want to build a villa in Shanghai, these are considered low density projects. The amount of land that is released for such projects is already tremendously reduced. So going forward, the luxury of space where you have the likes of like villas in Shanghai is going to be in short supply, and that is why company is also bidding the time to sell all these projects. And for CDL, their land that they acquired in China, most of them are acquired in 2010, 2011, 2012. If you look at the property prices from that time onwards, Shanghai, Suzhou, and Chongqing, they actually saw, especially Shanghai and Suzhou, they saw a 77% and 42% increase since that time. And what this means is that with prices having grown so much from the time they acquired the land, there is actually a bigger buffer for the company to cut prices if they need to, should projects not be able to sell. And then lastly, they have a few investments in the UK as well. You see some of these projects coming on board and achieving completion in 2017, 2018, and 19. And for those projects, the group remains confident of the high-end residential segment in London. So I'll touch on some of the risks to our views. Our call is an accumulate call, and some of the upside risks include if property cooling measures are unwinded sooner than we expect, with the ABSD and the TDS are in focus, or if the immigration policy of the government is loosened sooner than we expect it to be, or there's a depreciation in the Sing dollars, which actually would boost inbound tourism to Singapore. And for downside risks, that number one is a further slowdown in Singapore's real estate sector, and secondly, unforeseen circumstances such as terrorism, pandemics. Okay, lastly, I will move on to valuation methodology. So we have two major segments for the properties under CDL. Investment properties, where the company holds the properties for rental income. This is the more stable aspect of the portfolio, and this is a component that we have increasingly seen developers move towards as they try to achieve a more stabilized income year on year, instead of moving, so much into development properties, and then your earnings will be pretty lumpy year over year. So for investment properties, we apply a cap rate which is based on market rates. So those cap rates could be from the REITs or the properties in the vicinity, and then we apply the cap rates on the net operating income. For development properties, we value them at the NPV of the after-tax cash flow minus any costs associated. And you see that all in, if you add up all the different segments plus the listed entities, which we are taking them at face value at the market last traded value, you get a total gross asset value of 14 billion, which translates to a per share value of $15.83. And then if you add the cash minus away the debt, final RNAV will be 11 billion, translating to a 12.47 cents value. And after we apply a 20% discount to the RNAV, we get a final target price of $9.98, which after you factor in a 16 cents dividend, from current price, you're looking at an upside of about 16% from the current price of about 877. And as for the discount to the RNAV, 20%, how do we get it? 20%, we look at historical price to NAV for CDL. You can see that actually the valuations now, we are not far from what we saw in 2009. 2009, the trough valuations actually, it actually hit about close to 0.7. Right now we are doing 0.93, but we are still some way below the 6-year historical mean of 1.22. So with the mean at that level, and judging from the historical discount that CDL has traded to its RNAV, our use of 20% discount to the RNAV is actually, we deem it as conservative enough and lower than the historical mean. So lastly, I present to you a table of CDL versus the other competitors listed locally, the peer comparison table. So with that, I will pass on to the results segment.
Hi, good morning. Okay, SGX just announced the results, so here are some of the highlights. So generally, the securities and trading and clearing has been dragged down by the low SDAB. This is driven mostly by the slowdown in turnover. The turnover velocity for this quarter was 36% as compared to 46% in the same time last year. So this has been attributed to the low market activity and also the 14th of July shutdown. And the issuer services and market data and connectivity was stable. It was supported by the EC World REIT and the China Xinjiang Environment Holdings listing, and a stable bond listings, and also from the market data and connectivity will be the co-location services. So what has happened here is that this quarter the earnings have looked better on a quarter-on-quarter basis because of the lower operating expense, and this has been attributed by the much lower variable bonus and also the lower marketing expense. But generally, we find that given the management's guidance this quarter of 420 million to 430 million, we don't think it really surprised or give us any surprise on the upside for cost savings, because our previous estimates for FY17 full year is actually 429 million. So it didn't show better savings from our forecast. So we do not expect that to provide some of the tailwinds for net income this year. So as if let's say the SCAV is continued to be low for the next coming 2 to 3 quarters, then of course we do not expect the net income to surprise on the upside. So that's the reason why we have lowered the target price to 769, slightly lower than 799. That's also on the back of a very strong dividend. So we believe that the dividends itself would provide some support for the pricing. And some of the near-term initiatives would be the RMB initiatives to engage companies from Chongqing, Suzhou, and Tianjin. This is will be quite good for companies, Chinese companies from these cities to issue bonds. So that could actually provide more support for the bond listings. That's the end of my earnings update. Next, we'll have Keppel DC REIT.
Hi, morning. This is Richard speaking. So I'm going to present on the results for Keppel DC REIT and Cash Logistics Trust. So we published this report last week. The title is Preferential Offering to Fund Acquisition of Keppel DC Singapore 3. So that was one of the highlights during the results for Keppel DC last week. They simultaneously announced 3 different things. They announced their results. They announced the acquisition of Keppel DC Singapore 3, which was formerly known as T27, and they announced preferential offering. So let's look at the results first. So results year on year was lower for gross revenue. Few reasons for this. First was client downsizing since first quarter. A client in Dublin that downsized. Pardon the typo, this one-off non-cash downward adjustment at Elmere. This is their data center in Amsterdam, and drop in variable income in the Singapore properties, and also depreciation of the pound and the ringgit against the Sing dollar. So as you are aware, Keppel DC actually the portfolio is spread geographically, and they do have exposure to the pound and ringgit. Other currencies that they do have exposure to will be the euro and Australian dollar. Then let's go down to the DPU level. So DPU level was 15% higher, 15 or 16% higher year on year, but this included a one-off distributor income arising from a property tax refund in the third quarter of 16. So if that is worth about 0.23 cents, so you adjust that 0.23 cents out from the reported DPU this quarter, then the core recurring DPU would only be 167. So you can see that gross revenue fell by 12%, but the DPU increased by almost 2%. Now, on a portfolio level, occupancy was higher marginally from 92.3% in the second quarter to 92.7%, but this was at the expense of negative reversions. So where the negative reversion came from is at Keppel DC Singapore 1, which was formerly known as S25. Okay, sorry, this is about talking about high occupancy first, not the negative. Oh yes, negative reversions as well. So occupancy increased quarter on quarter from 85.7 to 87.6 because of a client that was expanding its space requirements by 6,800 square feet. So if you recall, the last quarter actually management had already disclosed this and said that they gave a negative reversion for this client because the client was expanding. So first phase of the expansion, the total rent will be lower than the last rent, but after the expansion, net effect will be a higher rent for this client. The second place that I want to talk about is Keppel DC Singapore 2, which was formerly known as T25. They maintain their 100% occupancy. One of the major clients had renewed the lease in this data center for more than 5 years and extended the WALE of this data center to 4.2 years from 1.2 years. However, they had to give an 8%, negative 8% reversion for this client as a kind of like a bulk discount, and they also said that this client is present in other data centers within their portfolio. By looking at last quarter's lease expiry profile and this quarter's one, we compared it, and based on that, we estimate that this client occupies a significant proportion, a significant amount of space in this data in Keppel DC Singapore 2. We think that it would be of the region of about 75%. Now moving on to the acquisition. So they announced that they'll be acquiring a 90% interest in Keppel DC or KDC Singapore 3, which was formerly known as T27, and they're targeting the acquisition for December. First thing first, this acquisition will require unit holder approval at an EGM. In terms of occupancy, the property already, or rather the data center is already fully committed to 2 clients. The good thing about this data center is stability of income, because income will be in denominated in Singapore dollars, and the stability will come through because of the long WALE of 5.7 years for this particular data center. Okay, and then now we move on to the preferential offering. So preferential offering is a 274 for 1,000. So meaning that for every 1,000 units you own in Keppel DC, you will be allocated 274 units to subscribe to. The intention is to raise a 279.5 million, and this would increase the unit holder base by 27%. So that is fairly dilutive. This 4 bullet points shows how they intend to utilize the funds. So bulk of it, 208.6 million, will actually go to the acquisition of Keppel DC Singapore 3. You can see that 33.4 will be to repay a loan that's associated with the acquisition of IC2. So there's an IntelliCenter 2, which is one of their properties in Australia. And another 33 million is to repay other loans, capex, and or future acquisitions, and 4.2 million is for fees. So if you recall, actually, Keppel DC in the last few months, they've actually announced 2 other acquisitions. One was the data center in Milan, and the other data center in Cardiff. So they said that both of these acquisitions will be fully funded by debt. Cardiff acquisition has been completed. Milan one hasn't been completed. So one thing that I'll point out is that although they have funded it by debt, but the thing is that you have to take into account that the timing between this equity fundraising to lower their gearing comes in a very short span. So actually, unit holders will probably not be enjoying any of the yield accretion or the DPU accretion that was originally promised when they made the 2 acquisitions. In conclusion, we still maintain our accumulate rating on Keppel DC REIT. Our target price is 126, which we had lowered it from our previous target price of 129, slightly lower. This is due to the dilutive preferential offering. Our forecasted DPU for FY16 is 7 cents, so that would translate to a yield of 5.7 cents based on the last closing price of $1.18 last Friday. Next is Cash Logistics Trust. We published a report this morning. The title is Takes a Hit from Schenker Mega Hub. So the biggest news for during the results is that their property at 51 Elks Avenue, which is also known as Schenker Mega Hub, was revalued downwards by 31%. This was partially due to, or rather, it was entirely due to the ongoing court litigation they have with the tenant at that property. So this is the results. Gross revenue year on year was 21% higher. This is contribution from their 6 Australian properties that were acquired in first quarter and fourth quarter of last year. And contribution from the DSC ARC. Of course, offset by lower income from Schenker Mega Hub. If you go down DPU level, DPU plunged almost 14%. Also, this is due to a larger unit base in third quarter of 2016 versus third quarter of 2015. Here, distributable income in the third quarter last year includes capital distribution. This is from the divestment proceeds of the Kim Hing warehouse. So if this 1.51 million translates to about 0.192 cents per unit. So if we adjust that capital distribution out from last year, that would be a core recurring DPU of 1.948. So year on year DPU was still down 5.2% despite the 20% increase in gross revenue. So okay, our first bullet point here says no capital distribution component this quarter and do not expect it going forward. So as I mentioned, there was this divestment of the Kim Hing warehouse, and there still is a balance of about 3 million from that. So management has indicated that this capital from divestment will be used for other purposes, such as CAPEX, and they're not making any commitment to distribute the balance, this balance 3 million in subsequent quarters. The other thing would be 51 Alps Avenue. So as I mentioned, it was the fair value was adjusted downwards by 31%. That was by a revaluation of 36 million from 116.8 million to 80.7 million. The basis of this that the independent valuer came to is based on the new market rent, which is about between 140 to 150 PSF per month on a single net basis for the next 5 years. As a consequence to the lower asset value on the balance sheet, aggregate leverage for the REIT has increased from 39.8% to 41.2%. So management has also said that in view of this, they will intend to recycle capital. They will be disposing of lower yielding assets to pay down their debt. But their strategy for growth is to still focus on acquisitions in Australia. In all, we think that the prospects for them for acquisition has dimmed because of the higher leverage, and if they were to dispose of assets, then you would have to expect a downside to their organic DPU as well going forward. In conclusion, we maintained our reduced rating on cash. Target price was unchanged, 81 cents. The forecasted DPU for the full year is 7.58 cents. That will give you a 8.6% yield based on the last close price. Okay, we've come to the end of today's webinar. It's been a lengthy one. I'll just remind everyone again that the location, our archive for our past webinars has changed. So please look at this link that I'm highlighting now on the screen. This is the new address for our webinar archive. So if you would like to download the past PowerPoint slides or re-watch the past videos, this is the link to go to. Our slides and the video typically would go up by Wednesday. Okay, we'll take a pause now for questions to come in. Okay, this is Richard again. Yeah, there's a question on Keppel DC REIT. First question, well, okay, couple of questions. Couple of questions on Keppel DC REIT. So first question is about the negative rental reversion. Is it a one-off or a trend really? Is it expected to have more negative rental reversions? This, I think, would be a combination of both one-off and a trend. The negative 8 sounds quite alarming, but bear in mind that it was given to only one client who has substantial, who is taking up space in various data centers within the portfolio. So likely negative reversions could be a trend, but that magnitude is a one-off. Going forward, if you look at their lease expiry profile, they actually they have insignificant amount of expiries in 2016 left. 2017 they have got about 21%, but thereafter 18, 19, 20, each year is less than 3% expiring. So the concern should only come in for 2017. 2017, if you refer to the report, actually they have 3 major leases that are expiring. One in Singapore, one in the Basis Bay data center in Malaysia, and probably one in the Keppel DC Dublin. So at this point in time, still no visibility on how things will pan out. But for the data center in Malaysia, management also have shared that the tenant has indicated that it will be renewing the lease, but obviously nothing has been disclosed yet for the rent. Second part is about the preferential offer price advisable to take up access. Why is the company doing a preferential offering when their gearing is not that high? Let's say, okay, so actually the gearing will go higher because they are going to acquire the Milan data center as well. For Keppel DC, they have really stated quite often that their long-term gearing target is actually to maintain at 30. So that's why they are going to pare down their leverage level. There's another question on cash. When the legal case is settled, what is the estimated rental per unit that can be obtained from this location? Okay, so at the current moment, they are paying 77 cents PSF per month. This is on single net. If the case, if they win the case, if cash wins the case, then the rent has been assumed by the valuer to go to between 140 to 150 PSF. That is also on single net. Take note that the last rent was about 153, but that was on a triple net. So this is 140 to 150 on single net, meaning that cash will have to bear the cost of the land rent and insurance. So that is if it's settled, and if that is a positive outcome, so then obviously the tenant would have to pay back the shortfall for the period where it was paying 77 and it gets adjusted upwards. If it turns out unfavorable for cash, then they would have to continue at the 77 cents, and as stated in their press release, the property would have to be further revalued downwards to 66.6 million. As for the question about how long the case will drag, that is up to the courts. Nobody will know the answer to that.
Hi, this is Jeremy, technical analyst. So there's a question asking about my views on the US market and STI. So what is shown right now on the screen I have over here is the S&P 500. But just to go through with you guys briefly the macro outlook. As of now, pretty much the market is staying in a range bound, probably because of the US election that's coming up soon, 8th of November. That will be the date of the election. So from now till the election day itself, probably we'll see this kind of a sideways ranging motion that we have seen for the past 2 to 3 months. So you can see over here, this is S&P 500. There isn't much going on within this particular index. Same for the other two US major index, like the Dow Jones as well as the Nasdaq. So from now till 8th of November, probably the market will stay range bound within this area. Out the lines over here. Pretty much stuck in this range. For the S&P 500 would be around 2193 to about 2 220 level. So moving forward from now to 8th of November, we don't expect much catalysts coming into the market. So for S&P 500, probably we just stay range bound between these two levels. And till then, when the election gets closer and when the results get reviewed, probably a Hillary win would cause a relief rally for the S&P, and probably we'll see S&P probably heading higher, continuing its immediate uptrend on short term. And on the flip side, if Donald Trump victory were to materialize, we would expect the S&P to actually fall below this range low of 220 level and could easily see a sharp fall similar to the one that we have seen during Brexit, which caused the S&P to fall in the range of around 3 to 4% in a single day. As for the view on the STI, STI is pretty much stuck in the range bound as well, similar to the S&P 500 or even worse. So probably the STI will just track the US market closely. So same views over here. STI will probably stay range bound, drawn over here around 2,900 to the low of around this level of 2,795 area. So we would expect more consolidation and sideways motion moving forward as well, because we are entering into the holiday seasons right now. December period is coming up, so probably the market will stay pretty much stuck in a sideways motion. And if there is no other questions, we thank you guys for tuning into the webinar this week. Hope to see you guys next week. Bye.